Hello guys, welcome to another video where we are going to talk about some of the tricky adjustments in ISC accountancy, and these adjustments will not only be useful for ISC students but also for CBSE and state board students as well. In this video we're going to talk about the partnership fundamentals, some of the tricky adjustments that will be really useful and helpful for you guys to do the sums flawlessly. So the first one that we have is interest on loan from partner. And this is the loan which the firm has taken from the partner and the firm is paying interest on that to the partner. So first thing to be noted that this interest on loan is a charge against profits. Okay. So this will be debited to the PL account and credited to the partner's loan account. Don't be confused. This will not be debited to PL appropriation account. Okay. And this will not be credited to the partner's capital account. These are the mistakes which students mostly do. So let's have a look at the journal entries. The first one is interest on partner's loan account debit to partner's loan account. Okay. This is the interest due. And the second entry is the closing entry where profit and loss account is debited to interest on partner's loan account. All right, be very careful. So now in the question, most of the time you will see that the net profit is given before charging interest on partner's loan. That means the interest on partner's loan has not been charged yet. That means it is not yet debited to the PL account. Okay. In that case, all you have to do is on the credit side of PL appropriation account, where you write the profit and loss balance, net profit, from there you have to subtract the interest on partner's loan to get the final adjusted net profit. You cannot debit this to PL appropriation account. Okay, interest on partner's loan is not an item of appropriation. That is why it is subtracted here to arrive at the correct net profit. All right. So next one that we have is interest on loan to a partner. So in that case, the firm has given a loan to the partner. In the in the previous case, the firm had taken a loan from a partner. In this case, the firm is giving a loan to the partner. In the previous case, nothing comes in the partner's capital account. Be careful about that. Let's have a look here. So in this case, this is an income to the partnership firm, so this should be credited to the PL account and debited to the partner's capital or current account as the case may be. All right, in case of fixed capital, it is debited to partner's current account. In case of fluctuating capital, it is debited to partner's capital account. Let's have a look at the journals. The first entry, partner's capital or current account debit to interest on loan to partner account. And the closing entry is interest on loan to partners account debit to statement of profit and loss account. All right, let's have a look what adjustment we need to do in the PL appropriation if the net profit is given before adjusting interest on loan to partner. Just the opposite to the previous one that we saw. In the previous one, we had subtracted the interest on loan because that was an expense for the firm. However, this is an income to the firm, so this is added to the net profit to arrive at the correct net profit. All right. Be very careful of these adjustments. Again, you cannot credit it separately in the PL appropriation account as this is not an item of PL appro. Let's have a look in the partner's capital account. So this will be debited to partner's capital account because this is an expense for the partner. Partner is paying this to the firm, right? That is why it is debited to the partner's capital account. Next one that we have is rent to a partner. Now this is also a charge against profit. This rent will be debited to the PL account and it will be credited to partner's current account in case of fixed capital system and or to partners capital account when the capitals are fluctuating. All right. So this is also similar to the first case that we saw. The journal is rent to partner account debit to partner's capital or current account, and statement of profit and loss account debit to rent to partner account. In the first case only, the difference is the interest on loan did not come in the partner's capital or current account. However, rent comes in the partner's current or capital account. Let's have a look at the PL Pro adjustment. Profit and loss account, again, net profit which is given to you on the credit side. From there, you will have to subtract the rent to partner, okay, to arrive at the correct net profit. In the partner's capital account, we will credit this to the partner's capital account. Okay, let's move on to the next one where we have partner's commission or general reserve. Both of these to be calculated on the correct net profit and not on divisible profit. Be very careful. Read the question carefully to understand this better. Let's have a look at the PL Pro. So here you will subtract on the credit side. If you have interest on partner's loan, if you have rent to partner, you will subtract them or add the interest on loan to partner, then arrive at the correct net profit, which is shown by triple Z here. Then on the debit side, when you're calculating general reserve, whatever percentage you are applying, that should be calculated on the final correct net profit that you arrive at. Same for partner's commission as well. Clear? And if you want to show it in the partner's capital account, partner's commission will be credited to partner's capital account. General reserve will straight away go to the balance sheet liability side. All right. Hope this was helpful for you to understand some of the tricky adjustments. We'll catch you all in the next video with more such tricky adjustments in the various chapters. If you have anything that you want me to cover, do let me know in the comments box below. If this was helpful, hit the like button, do share with your friends. Thanks for watching.